on how you should be analyzing the environment. And if you are reading the US economy indicators very closely and trying to join the dots back home, then you should think again, or the methodology in which you do it, because this is a tale of two inflations. In the afternoon, and it was a very interesting report which you have put out, and the discussion today would be on that. So these are two different inflations, right? Help us understand what was really fueling Indian inflation and the way developments have panned out last few days. Where do you see the trajectory of Indian inflation components from here on? And then we'll talk about the other inflation, is the US inflation.
Sure. Thank you for having me. So we think that India's inflation is largely, what we call imported. And of course, there are, a few agro supply shocks as well. So uh, because commodity prices went up a lot due to the global liquidity infused by the Fed, we too had inflation going up. And now that the Fed is tightening and bringing down commodity prices, we think inflation in India is peaking. As you can see, all commodity prices are falling. And I think effectively speaking, inflation in India has already peaked. Statistically, there will be a bit of a blip, maybe to close to 8%, I think, around September. But I would think that we should all look through that. So net, I think inflation will come down to 6.3% by March this year and 5.5% by next year. That's FY24.
Right. In fact, our RBI governor also recently met a clutch of FIIs in Singapore just a couple of days back, and they seem to be pretty confident that inflation trajectory is headed lower October, November onwards. By when do you see the markets, the bond market, the stock markets, will start getting convinced that indeed Indian inflation is actually heading lower? Because right now it appears to be the case that they are not very convinced if all these components coming down mean that the real reading will also head lower.
So I think that, all the fundamental drivers of inflation are fairly soft. Growth is slow. So you are not seeing, uh, you know, uh, much of demand. Uh, we are seeing good rain, so that should bring down inflation. Mr. Das at the RBI has kept money supply very tight. So, there isn't this money driven inflation. Commodity prices are coming down globally, as well as the RBI's high FX reserves provide protection to the rupee. So as the numbers begin to roll down, I think both the equity and the bond markets will be convinced that inflation is kind of yesterday's story, at least for India.
Right. In Sure. Indranil, how did you read the latest US inflation reading? The components of that one, especially rent, shelter, etc. And also, how do you recommend we all should look at the US inflation differently, the fundamental drivers there?
So I think that the big difference between US and Indian inflation is that US inflation is largely driven by cheap money. So if you look at M2, for example, which is US money supply, that had crossed 20% versus a long run average of 7%. In India, money supply has been actually lower than 14-15%, which is a long run average. And therefore, what is gradually happening is that the constituents of US inflation, which are rising, kind of suggest that it is the demand side pressure which is pushing up inflation rather than just a supply shock. Uh, at least experience shows us that when you have money driven inflation, like the US had seen in the 70s and early 80s, India saw till maybe the mid 90s. it takes time for that to come down. And in fact, history says that the Fed has always had to, tighten so much that they create a recession for uh, for inflation to come down. Uh, so there is a fundamental difference between, a supply shock driven inflation that we are seeing in India and a cheap money driven inflation that we are seeing in the US.
That's a very important, a very interesting way of putting it. Indranil, there is a sense in the market that the way numbers are pouring in, they're the case building for a mild inflation in US, mild enough to break the back of commodity, energy, all of that demand, but not deep enough that completely puts US economy in a tailspin. If that indeed happens, the sense is that going forward, the pace of rate hikes may slow down. In fact, not even that. By mid next year, there may be QE may be back on table. Do you subscribe to this argument or probability?
I think that, the history of inflation shocks in the US suggests that they typically take more than a year to come down. So when inflation has gone to where it has, 9% plus, we at least don't see it returning to the 2% level uh, next year in the US. So we are looking at about 200 basis points of hikes by the US from here on, as well as QT. And if that happens, the RBI will probably have to go to a terminal repo rate of around 6% at home.
Okay, I understand. Fair point. How are you analyzing the quality of growth now? Because when this kind of a growth slowdown happens across the world, Europe is facing issues. China, we all know the way GDP data came, and US is orchestrating a slowdown to cool down commodity prices, etc. Where does this put India as far as the growth trajectory is concerned?
So we are looking at growth at around 6.7% this year. Of course, June quarter will be statistically high, and then 5.5% next year. Now, again, based on experience, we estimate that a US recession will typically cost about 100 basis points of GDP growth for India. It remains to be seen whether that happens, but I think it's fair to assume that growth will be in the five handle in FY24. And that is why we think that towards the end of FY24, we will see RBI cutting rates by 50 basis points.
Wow, okay, that's how the cycle is likely to pan out. How are you looking at the ingredients of growth here, capacity utilization, etc.? When you look at which are the sectors which appear to be in good shape and where are things looking challenging?
So I think that there is no major engine driver of growth which is really in good shape, whether it is in India or anywhere else in the world. We have a consumption problem. Demand is weak. As you can see, the RBI's consumer confidence index is still below pre-COVID levels. We run at CLSA, India activity index that's up about 6% from 2019 levels. So consumption is weak, and because of lack of capacity utilization, capex also remains muted, outside of what the government is doing. So I think that uh, you know uh, we are we have been in troubled times, and those troubled times continue to a lesser degree. But as you said yourself, the global picture is again worsening. Uh,
Right. Indranil, we also saw credit growth here in India come up to upwards of 13%, in almost 3 years, and that too 2 months in a row we are upwards of 13%. Is it a good sign that credit growth is finally coming back? Up till now, only retail was driving credit growth, but now it appears that early inquiries from corporates, etc., for capex, working capital
Yeah.
have also started. How do you analyze this?
So we have been looking at a pickup in credit growth, largely because real lending rates have been low and nominal GDP growth is going up. Typically, if you see that when you come out of a big shock like whether it is the great financial crisis of 2008, whether it is the COVID shock of 2020, there is a bit of a relay race. So, first retail credit demand picks up. As there is demand by consumers, corporates start to, look at working capital, which I presume is what is happening now. And finally, when capacity is exhausted, you see capex loans. That I think is at least 2, 3 years away. But now I think that, we have so far credit growth has been largely driven by retail demand, and now corporate demand will kick in.
Right. All right, Indranil, we'll let you go on that one. Thanks so much for that differentiated paper and our discussion on that. We'll
Thank you
chat
very
with you
much.
once again sometime soon.
Sure, sure.
That was
Thank you.
Indranil Sengupta of CLSA